Hi there, welcome to Kneppy Invest and welcome to another technical update video. It is Sunday, 17th of August, 2025. Time is currently 10:17. There you go. If only it was at 8:17, that would have been even better. 8:17 on the 17th of August. Yeah, anyway. So what I'm going to do in today's video is we'll go through charts, but I'm going to do something a little bit different in this video. I'll talk about that in a second. Now, before I talk about that, yesterday, I didn't record any bank videos, but I've so far recorded 71. My plan was to record 65 because that is the amount of days I'll be away on my little trip, hiking trip. So the ultimate aim was to record 65 videos and release one a day. Now, I got to pass 65 up to 71, and I thought, well, I've still got 2 weeks. I can still record a few or even quite a few bank videos. So I gave myself a bit of a plan, and then I counted all these videos up and I realized I was close to 100. So that is my aim now. My goal now is to pre-record 100 videos to be released during September and October. And what I might do is actually record one video to be released the day I am leaving. And that video will be all the bank videos I've recorded, or all the pre-recorded videos I will be releasing during that 2-month video, 2-month period, not video. Anyway, so I have 29 videos to record in the next 2 weeks. I can definitely do that because a lot of these videos I am planning to record, I can do fairly quickly. Very little planning needs to be done. Okay, so look out for that particular video towards the start of September, probably September 2nd. I'm pretty sure that's the day I leave. September 2nd. Okay, so what I'm going to do in this video, and what am I saying, if I did say it, is this going to be a little bit different. So what I'm going to do in this video is I'm going to just focus on weekly chart and only the 200-week moving average for everything apart from the individual companies, which I may not get to, not sure just yet. And the reason I'm doing this is because of that investing strategy that some people thought that Munger had said or wrote, which I don't think he did. I'm pretty sure he did not. But it's actually a pretty good strategy. And that strategy is buy high-quality companies when they get to or are close to the 200-week moving average. It makes a lot of sense because high-quality companies, by the definition, should go up through time. The share price should go up through time. Otherwise, it's not a high-quality company. And that is actually the simplest definition you could have for a high-quality company. Share price or the valuation should increase through time, because otherwise, why would you own it? Why would you own it indeed? So that means because a 200-week moving average is a 4-year period, if the share price falls below or near that particular moving average, you could say, well, the share price has pulled back to the point where it could be good value. And you could even say, if you believe in mean reversion, and I'm a believer in mean reversion, that if the share price comes back to the mean or below the mean, in fact, I would say the 200-week moving average is not the mean. It's actually more like a margin of safety. So if you consider it a margin of safety and you bought a high-quality company, when it hits the margin of safety, that's good buying. So can we apply that to indices, commodities, crypto, bonds, that sort of thing? So that is what I'm going to do in today's video. Now, the first thing I want to do is get rid of any drawings I have. You could do that in TradingView, clicking on this hide all drawings option. And I've just changed the color of the 200-week moving average from red to black. I could increase the thickness by 1 size to make it clearer. I'm pretty sure black is the best, maybe. It stands out a little bit more, I'm not sure. Anyway, so this is the XGAO of a weekly chart over the last 10 years. And there is a bit of a signal here. I'm not surprised by this because I think this is a reason why ETFs work, or individual indice ETFs probably work. Broad indice ETFs work because over time they go up. So that is the definition of a high quality. Over time they go up, and indices go up, stock markets go up. That's why we invest it. Over time they go up. So I'm not surprised by this. But the other thing is the XGAO actually falls below the 200-week moving average quite often. In fact, during this 10-year period, it falls below it, every 2 years, maybe. 1, 2, 3, 4, 5, 6, 7. In fact, 7 times. And it does fall below on occasion quite for a period of time. Like during COVID-19, it fell below for a period of time. But then we saw a rally pretty quickly. And that period was a time when everyone was fear, maybe not everyone, but there was a lot of people out there with a bit of fear, and that's why they were selling. And don't forget that typically things or the market overreacts to the upside and also to the downside, and this does lead to opportunities. So whenever you see this sort of thing happening, when the price of a high quality asset fall below the 200 moving average, that could be suggesting that there is a little bit of fear out there, and that can be good buying. A little bit surprised it's fallen quite often below the 200-week moving average, but typically it doesn't take much time before it recovers. Now, it took a little bit more time, or stayed below the 200-week moving average a little bit more time in 2015. Now, that was during the bottom or near the bottom of the mining cycle. So that probably is the reason why there. And in fact, I can explain all these times why it dipped below the 200-week moving average. The bottom of the mining cycle in 2016. In late 2018, that was rising interest rates, or the threat of rising interest rates in the United States, and then the Fed pivoted on the 24th of December. I still remember that. Or it was late December anyway. And that's why we saw a rapid rise in the XGO, because it was just a pivot from the Fed. COVID-19, obviously. Twin drops below the 200-week moving average in 2022. That was falling interest rates, and that was a great time to buy. But I don't know why it bounced off it in October 2023. So that's one time when I can't think of the reason why there was a little bit of weakness in the overall market. And then most recently was the tariffs. Yeah, and in fact, we saw a rapid recovery in the XGO during that period. So that was actually based off this little strategy. That was great buying. In fact, it was probably one-day buying. And there was a rapid reversal, if I remember correctly. Okay, so we can go back further in time and just have a look at some of these more interesting periods. Like there was a massive, I don't know if you remember this, maybe you don't if you're too young, but there was a really good bull market in the 2000s. And that was an interesting period. And then we saw the GFC, and that was great buying. Well, you don't know exactly the bottom, but great buying started probably in September. But September, October was probably peak fear, if I remember correctly. Everything, all the banks are going broke, that sort of thing. But then the bottom in the XGO was in March 2009. That correlated with the Dow Jones, but the Nasdaq bottom was in late 2008. That was great buying. And I started investing back in 2010 or 2011. I can't remember just yet. And that was great buying as well. And everyone was saying to me, don't buy it. Stock market's too risky. Stock market is too risky. Again, max fear. Maybe not extreme max fear, but a lot of fear when it came to the stock market back in those days. And that was great buying. That was great buying. Probably the other one was tech bubble, but you don't really see that on the XJO. So over the last 15 years, yeah, this has been a pretty good strategy, I think. It's been a pretty good strategy. Just become bullish when the XGO falls below the 200-week moving average. Just fine. Your high-quality companies. And if your high-quality companies also have a similar chart, then this, buy, buy, buy. Okay, so does this translate to other indices on the ASX? I'm a little bit dubious when it comes to the XSO. In fact, this is interesting. Yeah, I'm not surprised by this, because the XSO peak was actually in 2007, and then you can just see it collapsing during that period. But what is really interesting about this one is if you look back between 2011 and 2016, the 200-week moving average actually acted as a resistance, not support. In fact, almost perfectly resistance. You can see it bouncing off the 200-week moving average about 1, 2, 3, 4, 5 times before finally it broke through. Now that does mirror what happened with mining. That was the downtrend in the mining cycle, and the bottom in the mining cycle happened in early 2016. So in some ways, looks like the small caps mirror more mining. So there's more cyclicality when it comes to small caps in this index anyway, than in what you might realize just based off that period. Now, otherwise, since then, generally you do see a bit of upside with these small caps, except when there's underlying issues like the mining cycle, and also in 2022, 2023, we saw it remain below the 200-week moving average for quite a while, a few years, and that was during interest rates rising. So interest rates rising period, which by definition, probably affects small caps more than the larger caps. Right now, it's looking fairly bullish. Probably the other thing I should mention is sometimes you could say an index might be, or even a company might be too stretched by the standard deviation. Standard deviation, it is away from the 200-week moving average. And right now, the XGO is a fair distant away from the 200-week moving average, which does increase the chances of a bit of weakness. Doesn't mean it's going to happen, but just means there's a greater chance now we're going to see some weakness moving forward. Now, again, doesn't mean it's going to happen because we saw that back during the big bull run in the 2000s. It was well above the 200-week moving average for a long period of time. Okay, so I just not remembered that, but I just thought that with the XSO right now, it's getting well above the 200-week moving average. And over time, we do see a little bit of weakness when that does. We can see a bit of weakness when that happens. Okay, now on to the XTL, which is the ASX 20. I think it's going to be fairly similar to the XJO, which sort of makes sense. There's a bit of correlation between the two because the XTL is the top 20 companies. The XJO is the top 200 companies. And I'd say by far the biggest 20 companies in the ASX 200 are not 20%. No, 10%. It's probably more like 30 to 40%. So there's going to be some correlation there. And just by looking at this, yeah, there's a bit of correlation between the XJO and the XTL. It's not perfect, but I think we can move on. Now, the next two indices haven't been around for too long. The XTX and the XBK. I'm pretty sure the XTX started just before COVID-19. I can't remember the XBK, but it hasn't been around that long. So we don't have as much history here. And yes, in fact, I for some reason, I still remember the All Technology Index starting just before COVID-19 or in COVID-19. And that does support that thought. Now, we don't have much history here. In fact, the 200-week moving average has just started. Well, started about a year and a half ago. But interesting enough, what little history we do have, you can see the XTX bounced perfectly off the 200-week moving average back in April. Okay, so one sample size, but a nice little sample. Now to the XBK, I'm pretty sure this hasn't been around for all that long either, 2019. So we have a little bit more history than the technologies indice or tech index, whatever it's called. And the other thing I should mention here is over the last year and a half, we have seen the banks go on a bit of a bull run. And that bull run has been caused by multiple expansion, not necessarily financial expansion. And you want the complete opposite. You want the valuation of a company to go up because of financial expansion and not necessarily multiple expansion. Although when you get multiple expansion on top of financial expansion, that's 2 thumbs up. So this is the whole reason the banking sector has gone up over the last year and a half is because mostly multiple expansion. The P ratio of CBA has gone from 15 to 30 and with very little growth. But in saying that, it's remained above the 200-week moving average since it started back in 2023. So not enough history for me to get or say anything about this particular index. What about the XMM, the ASX, was it 300 or 200 mining? I imagine there's going to be more cyclicality when it comes to this one. So I expect between 2011 and 2016, fairly similar to the XSO, that this particular index would be below the 200-week moving average, and maybe the 200-week moving average acts as resistance, just like the XSO. Let's see if that is true, if we see more of a cyclical nature to this particular index. And so far it's true. Oh, yes, definitely. So just like the XSO, a lot of weakness in this particular index for 5 years between 2011 and 2016. And that was the downward bit in the mining cycle. And the bottom of the mining cycle, if I remember correctly, was the start of 2016. And that was great buying for many of the iron ores, including BHP. And you definitely see a bit of a cyclical nature to this, even though it hasn't been around all that long. 20 years isn't really enough to capture all the mining cycles that have happened. Now, if you actually have a look at this, you could actually say the top of the mining cycle happened in early 2023, and it's showing signs of moving back into a downward cycle. Now, I'd probably support that, But we have seen a little bit of strength in the mining cycle or the mining sector in the last few weeks, and we did see a breakout of a short-term downtrend. So maybe this is not, maybe it's not the truth. We're started the downward cycle in the mining just based off this chart. Okay, so that's the Aussie indices, and yeah, I think this is. I think using the 200-week moving average probably could work for these indices, particularly the XJO, maybe the XTX, the All Tech, XTL, maybe not the XSO or XMM, but you definitely even use it for long-term cycles. Okay, now on to New Zealand. What am I thinking about New Zealand? Oh, actually, I have in the back of my mind, I can remember the New Zealand weekly chart surprised me quite a few weeks ago. I did not expect what you're going to see here. And yes, I did not expect this sort of chart. And now this is the NZX50. Now it's probably some of the bigger companies in this probably control the movement of this particular index. But look at this. In fact, from 2012 through to the COVID-19, so 8-year period, the New Zealand X50 remained well above the 200-week moving average. So even though if you looked or, use standard deviations, and if it was, say, 2 or 3 standard deviations above whatever, you could say that should mean a bit of weakness. That would have been wrong for this particular index. So just because the index or even the price of a individual company is well above the 200-week moving average doesn't necessarily mean there's going to be weakness, because this particular index remained well above the moving average for a long period of time. Now, even in saying that, generally, it has remained above the 200-week moving average. Now, on occasion, over the last few years, it's gone below it, but just briefly, and it bounced beautifully off it a few months ago, in April, yeah. Probably the only thing about this, it doesn't look like it's going in a sideways sort of period. Looks like the peak was reached in 2021, so 4 years without a new high for the NZX50. Okay, so yeah, no problems with that one. Now on to the United States, and I'm pretty sure I know what we're going to see here. I'm pretty sure this particular strategy would work brilliantly for the Nasdaq, NDQ, S&P 500, Dow Jones, not sure about the Russell 2000, but the other three, I'm pretty sure this is going to look spectacular. I'm pretty sure. So let's start off with the NDQ, the Nasdaq 100, and yeah, straight away, yes. In fact, unbeknownst to me, I was using this strategy. Well, not really, because I think if you're using a strategy, you have to know you're using it, but subconsciously, maybe not subconsciously. But I was buying a lot of my American holdings back in 2022 when we saw a fair bit of weakness in the NDQ. And during that period, it fell below the 200-week moving average for a brief period and then rallied. So it looks like straight away that was a great buying for companies within the NDQ or just the NDQ ETF. And recently, very recently, during that tariff Trump, whatever it's called, it got very close to 200-week moving average, very close. And I do know quite a few experts were buying some of the Mag 7 stocks during that period, very heavily buying some of those companies, including NVIDIA. Anyway, so if we go back further, during the COVID-19, did not go below the 200-week moving average. Wow, I'm surprised by that. In fact, it bounced off it almost perfectly. Look at that, beautiful bounce off the 200-week moving average. Got very close to the 200-week moving average during that week period in late 2018. And look at how it just remains above the 200-week moving average as we go back through time. Now we have to go back all the way to GFC before we see it remain below the 200-week moving average for a long period of time. And I think that is when you will see this happen, when there is a pretty big recession or something big is happening, like a recession or bubble burstings. I think you're going to see this happen during the bubble burst. And don't forget, the market overreacts to the upside as well to the downside. So when you see the bubble bursting, and I think the whole definition of bubble bursting is you see too much hype in the upside, and you see the valuations get vastly stretched to the upside. But then when it bursts, you're going to see the complete opposite happen, and you're going to see the market overreact to the downside. And I think that's what happened. between 2001 and 2003 or 4. The market was overreacting to downside, a lot of negative sentiment in the tech space, and it took a while for that sentiment to shift. It took a long time. In fact, I'd say it took ages. It took probably 10 years before sentiment shifted back to being really positive. And wowzers, look what's happened since then. You can even go back further. And even before the bubble burst, this strategy would work like a charm. So just beware of bubble bursting and recessions or deep recessions. That's when you're going to see a lot more downside possible. Otherwise, looks like a great strategy for the Nasdaq. I'm not going to look at the S&P 500. It's going to be fairly similar to the Nasdaq. If you don't believe me, let's just have a quick look at this S&P 500. It's going to look almost identical. Yep, almost identical. So we can move on to the Dow Jones. What about the Dow Jones? And I would expect this strategy to work pretty good as well. And it does. It does. Over the last 15 years, it's worked beautifully. In fact, in April, it almost perfectly bounced off the 200-week moving average. What a... Ooh. Fell briefly below in September 2022. Of course, during COVID-19, it fell well below, particularly compared to Nasdaq. And then look at that, bouncing beautifully off it, very close to bouncing off it in December 2018, bounced off it in February 2016, and sort of bounced off it in August 2011. During the GFC, yeah, it was well below the 200-week moving average. But again, I think that's just the market overreacting to the downside. And during the tech bubble bursting, Dow Jones Industrial was not quite as affected as Nasdaq. And we can definitely see that. But even then, there was still a bit of weakness in this particular indice. Interesting enough, remember the XGO? There was a massive bull run in the 2000s. We don't really see that with the Dow Jones. So that was a great period to be very bullish on the Australian stock market, seems like. What about the Russell 2000? Can we use this strategy for US small cap 2000 index? And I'm thinking yes. Although that's not the, yeah, I'm thinking yes. Although not as strong as some of these other indices, but definitely if it does fall below, that's probably less risk buying. Anyway, so it's probably all I'm going to talk about when it comes to Russell 2000. We could go back further, but yeah, we don't. Definitely, there's a signal here because over time the Russell 2000 has been going up, so it's a little bit different than the XSO. Okay, now on to some international indices. So we'll start off with the Nikkei, and this one's going to be interesting because we do know that it took 30 years before the Nikkei got to a new high. So let's have a look at this one. And okay, so initial thoughts, yes, Nikkei, the Japan 225 index looks like a really nice quality index. Yes, in fact, in the past year, we've seen it twice get towards the 200-week moving average. The first time was the tariff Trump debacle, and before that was the Yenko trade debacle. So two debacles. Saw a little bit of weakness in the Nikkei, but then we saw rapid recovery. And before that, very close. In fact, it bounced off it a few times in 2022. So that was rising interest rates, which didn't really affect Japanese as much. There's the what do you call it? The COVID-19. There's in late 2018, that's the little bit of weakness in the markets because of rising interest rates in the United States. I'm not sure. So 2016, is that also because of mining cycle? I don't know. And then before that, we have, a long period of time. That was a long period. This is what I was thinking we might see here. So the Nikkei remained below the 200-week moving average for about 5 to 6 years, between 2008 and 2013. There you go. That is what I was expecting to see, and we're going to see this as we go a little bit further back because, again, the peak in the Nikkei was 1989 or 1990. And look at that. Look at that. This is just like the tech bubble bursting. But the burst, instead of a pop, it looks like the Japanese or the Nikkei, when it popped, it just deflated very slowly. Well, initially much quicker, but then very slowly. That's interesting. It took a long time for it to deflate. Wowzers. There you go. But since then, yeah, it's been working. This strategy works pretty good for the Nikkei. What about the Hang Seng? Not sure about this one. And I think recency bias is the reason I'm saying that. And yeah, this one's all over the place. This one is all over the place. So it doesn't really work for this one. Now, over time, looks like the Hang Seng does go up, but it just, yeah, but I suppose because it does go up over time, when it does go below the 200-week moving average, that's good buying. But sometimes it goes or stays below for a long period of time. And I think this is why I've been a little bit biased against this one, because it was below for about 4 years recently. And now it's above. So I suppose that was good buying. And I suppose I did buy a few. Well, I suppose I did buy a few, or one Asian-based company, because I thought it was fairly good value. Okay, now on to some European ones. We'll have a look at the DAX and FTSE. I'm assuming these are going to look fairly similar. Yep, we're going to get the same signal here. Yep. I would have said that DAX might be a little bit stretched when it comes to valuation. And with the DAX well above the 200-week moving average, maybe that's true. And we get the same signal here. Beautiful signal. This goes all the way back to 2006, so 20 years. And yeah, so same signal there. And I'm assuming with the FTSE, same sort of signal. Although you do get, when we see the FTSE go below the 200-week moving average, oh, it does go below. But this one goes below quite often. Quite often. And recently it went below during April. Yeah. So it's still same sort of signal, but not as strong as, say, the Nasdaq, even Dow Jones, but still a fairly strong signal. Fun enough, looks like this particular index was affected by the tech bubble burst more than some of the other indices. It fell a fair bit. It more than halved. Did not know that. There you go. So probably less a signal here, but still a bit of a signal. And what about TSX? I'm assuming this is similar to the XJO. And yeah, and same thing with the XJO. Yeah. So straight away, as I look at all these indices, yeah, I think you could use the 200-week moving average. And whenever you see the 200-week moving average fall below or near the 200-week moving average, did I say that right? Whenever any of the indices fall below or near the 200-week moving average, ooh, that could be an interesting time. And now if we see it, if we have, say, a severe recession, bubble bursting, then you might see it fall well below the 200-week moving average. So that's the only thing you might say is it all depends. But even then, you're going to see a recovery eventually, and you'll see it get above the 200-week moving average. There you go. But can we use this for commodities? I'm unsure. I'm unsure about this one. And I do know some commodities, there is no way this is going to work. No way. Gold, maybe. Gold, maybe. See, even gold, even this one, you get long periods of time when gold just does nothing. And that was definitely true for about 8 years between 2012 and 2020. Gold during the period between 2011 and 2016. So gold was dropping, iron ore was dropping. That was the downward cycle in the mining, the downward bit in the mining cycle. Right now, you maybe could say it's well above the moving average. So does that mean we're going to see a bit of weakness? Now, we saw a nice little bull run in gold back between 2002 and 2012, so a nice little 10-year period, and that was a great period. In fact, it did remain above that moving average for quite a while. Only one time did it bounce, and that was during the COVID-19, that was during the GFC. So just a little bit of weakness during the GFC, but overall, that was a great period. And this does look more cyclical, but the downward bit in the cycle is much less extreme than the upward. So the bear runs are less extreme than the bull runs, and that is why over time gold goes up. Look at this. So it's a nice looking chart. And I would actually say, just based off this, if you have a long-term horizon, when gold moves below the 200-week moving average, if you have that long-term horizon, that's a time to buy. You just have to be patient. You have to be patient by looking at that chart. I would say it's similar to silver. I would be shocked if this is too much different. maybe a little bit more volatility. Yeah, a fairly similar signal. And yeah, much more volatility in this one. You can see silver has not got back to its highs that it reached in 2011. And yeah, so, but same sort of signal when it comes to silver. Maybe not as good as gold. What about copper? Now we're getting to some of the commodities where I think less likely to have any strong signals. Yeah, copper, I suppose over the last 20 years, copper has gone up, but less signal here. And of course, this one's going to be more affected by downturns in the economy. And we definitely saw that during the GFC. So that's another thing to take into account when it comes to copper. Iron ore, no, I think no. Oh, for some reason, this only goes back to 2014. But definitely iron ore was dropping in those early 2010s, and the bottom was in 2016 when the iron ore price was like $40. So less signal here, and you can just see over the last 4 years or so, it's just oscillating above and below the 200-week moving average. In fact, right now it's below. So is now a good time to be bullish on iron ore? I'm not so sure. But maybe it's below the moving average. Uranium, this one's going to be highly volatile. And yeah, this goes back to 2006, highly volatile. I'd say this is more of a cyclical thing, if anything. It's interesting because during the what's it called, the Japanese tsunami thingy, that was 2011. Was that 14 years ago? It was trying to get into the bull run, and then that just destroyed that any sort of bull run, and that was sort of the harbinger of what was to come for uranium for the next 10 years. And it finally broke out in 2021. Oh, and look at this. However, look at that. Back in April, it did fall below the moving average for a brief period and has rallied since then. So maybe that was a time to buy uranium. Okay, oil? No, I'm going to say right now, no. Oil is definitely not. Oil is just like, meh. And the reason I know that is because oil has done nothing for 20 years. It's done nothing. It's just gone sideways for 20 years. Bit of volatility in there, but it's gone nowhere for 20 years. So there is no signal here at all. Although if you said there was, it's below the moving average. Good buying, but nah. What about some of the other commodities? Natural gas? No, done nothing for 20 years. Or even longer. Natural gas, nothing. Lithium, well, this is going to be highly volatile. Yep, in fact, this one only goes back to 2021. So I think we can move on. We already knew that. What about coal? This is another really good cyclical commodity, and you're going to see pretty good cycles within this. Yeah. So this is more of a cyclical, definitely a cyclical mining thingy, commodity. Tin, I don't know anything about tin. Well, it's a small sample size, but the moving average goes back to 2019. And actually, there is a bit of a signal there, but not much of a sample size. What about nickel? I'm going to say no for nickel. Now, before 2023, maybe, but it has been below the moving average for the last 2 or 3 years. Does that mean it's good buying? Yeah, I'm not sure. What about palladium? And, well, funny enough, the first thing I've noticed here is it bounced off. So it's been below the 200 moving average for about 2 years, 2.5 years, maybe even 3 years now. And it looked pretty good on the daily chart. Looked like there was a possible breakout, but the 200-week moving average acted as resistance back in July. There you go, like a month ago. But anyway, this may be more looking like a cyclical chart than anything. And what about cocoa for gills? Ooh, look at cocoa. That's why chocolate's so expensive. Okay, now onto crypto. So Bitcoin first of all. So this is going to be interesting because if you go back, a lot of volatility, Yeah, so this looks like bubble bursting. So this was back in 2018. Yeah, that does look like a bubble bursting, doesn't it? How the share price or the price of Bitcoin just went exponential. Yeah, that's a very good sign of a bubble. And then it bursting and it collapsed. It did collapse to below the 200-week moving average, and that was a bit of support. And then it fell below the 200-week moving average briefly during COVID-19. And since then, yeah, that's actually good buying. In fact, I bought some Bitcoin just around there when it fell below the 200 moving average. I was not using the signal, however. I thought that was good buying for Bitcoin back then. And the price of Bitcoin has quadrupled since then, has remained well above the moving average since 2023. So about 2 years. Yeah, I suppose even that strategy, the 200-week moving average strategy, works for Bitcoin. What about Ethereum? You probably could say the same thing with this one. A lot of volatility with Ethereum, probably way more so than Bitcoin. Not probably, way more so than Bitcoin. But even then, if you were bullish on the long-term future of Ethereum, buying when you see it fall below the moving average, yeah, that's pretty good. And it has bounced off, or did bounce off that moving average recently, and it's gone on a bit of a tear. The other thing I should mention here, without knowing this, it has come to the all-time high. There you go. Ethereum is at an all-time high. Okay, and what about bonds? Well, this one actually will look interesting over the long period of time, because the 200-week moving average should be acting as resistance as the bond yields have been going down for that long period of time. So in fact, if you just had a look at this and were trading like any sort of bond ETF with the price going up because prices are inverted or inverse related to bond yields, and in fact, you could see that with the TLT ETF, the time to be buying those ETFs is when, yeah, you can see the yields getting above the moving average quite often. And that's the time to be sort of bullish on the TLT ETF until recently. So things changed. So is that a structural change, or is this really good buying for the TLT ETF? I'll leave it up to you. And what about the Aussie dollar? Oh, no, that's not the Aussie dollar. What about the Aussie dollar? I doubt it. I doubt it, but it's more. It looks more trendish than anything, the Aussie dollar. But yeah, not really the sort of strategy you can use for. I would expect this to be true for all currencies. Okay, that is all I'm going to have for this video. No individual companies in today's video. I was going to have a look at a few companies, and these charts were looking interesting. But I might look at these charts during the rest of the week in the ASX Daily Rundown videos. AUE was one of them. I'm going to write that down. That was the one I was really interested in, AUE. Because that was a possible cup and handle, I think. Cup and handle. I saw that the other day and went, "Oh, this looks like a cup and handle." So I do have to write it down when I think of something, because then I'll forget if I don't write it down. That's all I have for this particular look at some charts. Just looking at focusing on the weekly and the 200-week moving average, using that strategy for indices or maybe ETFs, commodities, that sort of thing. Anyway, if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.